want to show you 7 reasons to look for a recovery, or 7 places to look for a recovery, change that you can believe in. When orders and inventory are out of balance as they are now, you cannot have a recovery. Watch for the order-inventory relationship. When the inventory levels come down and orders start going up, then you know you can have a recovery. You're not going to have a recovery until these trends realign. That's number 1. I'd also like you to keep your eye, a sharp eye, on corporate bond prices. The corporate bond prices 12-12 rate of change is not talked about by anybody besides ITR that I know of. Peter Perez here receives Ecotrends. If you want to know what's going on with the corporate bond prices, call Peter. I'm sure he'll be happy to answer 600 phone calls a month. Maybe just put on your recording, Peter. But this little darling has led through highs and lows very consistently for over 20 years. It leads through highs and lows by 10 to 15 months. The median is 11 months. It may be establishing a low now. It's a little too early to tell. If it's establishing a low now, it tells us that the recession ends late 2009. If the trough kind of slips into the first quarter, a few more months into 2009, it means the trough for the recession is going to slide into the first quarter of 2010. But it's getting ready to reach a low. It's bumping along a bottom and getting ready to move higher. And as it does, it'll be an empirical indication that there's change coming, that there's recovery coming. This is the light at the end of the tunnel, and it's probably not New Jersey. This is good news. This is an encouragement. As you look at this trend, you can say that this isn't going to last forever. I can get excited. I can plan for the future. Look at the Purchasing Managers Index. It looks very negative. It leads by about 9 months. It's the lowest we've seen the PMI on a monthly basis from the ISM since 1981. It's certainly telling us of the problems and difficulties that await us. But when this turns around, it'll be an empirical indication from an alternate source that the economy is going to get better. Watch for this. We think it's going to reach a low a few months from now, and if it does, it'll be shouted through Ecotrends, and you're going to know that life is getting better in 2010. The U.S. composite leading indicator is the same way. It's negative right now. It's telling us that 2009 is going to be gone, at least through the third quarter of 2009 at this point. When this turns around, you have another indicator that life is better. You look at the stock market, it's hard to get encouraged. The negative trends are real. They're painful. We haven't seen this since the Great Depression. Congratulations. We can now look our grandparents in the eye and go, us too. For the first time ever. We understand. We'll become frugal from now on. Want to bet? Number 1 question I get is, when will the stock market turn around? The answer is, how should I know? I'm an economist. My brother and I are very close. We're business partners, best friends, and we have promised each other we would no longer forecast the stock market. I'm on step 9 for the 3rd time in this endeavor. I can only give you statistical probabilities, and if you see my brother, I wish you'd even deny that. The statistical probabilities are these: that we're going to see a long, volatile bottom to the stock market. We're not going to see a V. We're going to see a very jagged U. And there are going to be those weeks where people are saying the bull is here, others when the bears return. Don't look for any sustainable upside activity according to statistical input only until we get to the third quarter of 2009. Then you look for a mild recovery. If you're looking for that height of October 2007 to come to us in 2009, you're going to be disappointed. It's not going to likely to appear for years to come. I mean many years to come before we reach that height. We're looking for a very mild increase in the stock market through time. And that if you need it to come back to October 2007 to retire, that's not going to happen anytime soon. You're going to be working a little longer than you anticipated. See, the rise that took place, you see 2 major rises on the screen. The one to the left is 5 years of double-digit growth. That's a generational event. The last time that occurred was 1925 through 29. They just don't happen that often. So you're not likely to see that quick rebound. Statistically speaking, by the way, if you're over 55, you won't live long enough to see that rebound, I'm sorry to say. If you're below 50, and a lot of you are, it will. 40 to 50 will be late in your life, you'll be in bonds, who cares? My age bracket, 50 to 55, we may be alive, but statistically we won't know what's going on, so it really doesn't matter. It's a non-event. Stocks. The bottom line is this, and this is contrary to what I just heard on CNN this morning, surprise, surprise. this is not the time to just let it ride in mutual funds and index funds. This is time to take charge. This is time to look for those industries that make sense given the economic climate that we're in, and what you hear about the rebuilding of the world through infrastructure, both IT and physical infrastructure through the rest of the world. That means you look for global companies who have a presence in infrastructure. You look for global companies who have a presence in nuclear power, wind power, solar power, because whether you believe in global warming or not doesn't really matter anymore. We're being told that that's the direction we're going in. We're going to fix the planet, and that means alternative forms of energy, and that means that what we talked about before will be used. Invest in those companies. Invest in solid companies. Invest in companies you know and that you like. Invest in yourselves. And you'll do better than just letting it ride on an indexed fund. And as you sit through the rest of this, I want to show you before we're done a list of areas that I think will be of benefit to you. Notice with me, please, that until we see retail sales get better, the economy's not going to get better. This is 70% right now of the U.S. economy driven by retail sales, below year-ago levels for the first time since the early 1990s. It's going to be below year-ago levels again, we think, for the end of 2009. 2 years of negative numbers for Christmas, not going to go over well. Thousands and thousands of retailers will be closed. People will be thrown out of work. That red line at the bottom is the seasonal trend. Can you see how weak that is this year? We haven't seen anything that weak in 61 years. We have just stopped buying. Why have we stopped buying? Well, a lot of people think it has to do with consumer expectations. You hear that in the press all the time. I want you to know that that's bogus. You look at consumer expectations, the purple line, you look at the green line, retail sales, and you'll see that one has no forecasting ability over the other. You cannot look at consumer expectations at any point in time and say, hey, that's an indication of what I should expect tomorrow, next month, next quarter in retail sales. There have been periods of time where we've been unhappy and bought more. We've been very happy and bought more, and very unhappy and bought more. There's nothing usable about consumer expectations. I think my wife has correctly identified this graph. She said the green line is her life and the purple line is my life. That's just... I'm working on the implications. I'll be through them soon. Housing starts are negative. There's nothing encouraging here in the graph. Existing home sales are beginning to show a little firmness. Home improvements beginning to show a little firmness, but nothing dramatic. We have more decline to come because we have more Alt-A's and another spike of refis coming at us in 2009.